All right, guys. Good afternoon. I want to say thank you, as always, for the opportunity to partner, hopefully provide value for you and your business. These presentations are designed to invoke ideas, so you can grow your community, so you can grow the opportunity to help people. And truly, again, as always, if you want to partner with Valor, with our subsidiaries throughout Valor, because once again, Valor is literally two people. It's myself and my wife. Our job is to help you guys grow your business, grow your community, and grow in your areas. So I always say, the idea is if you do good for your community will do good for you. And so that's why we talk about opportunities like what we'll talk about today, working with small business owners. So it's a comprehensive guide to protect and grow small businesses. The idea truly is how can we separate ourselves from the landscape of our competitors. So a lot of people are often fighting for, clients' return insurance, final expense, stuff like that, when out here there's a great opportunity that's lying ahead of you. So when we talk about what we're going to look at today, the hope is that you can confidently understand on what type of solutions are really available for the business owners, and ultimately why that matters for you and how to position that. So we will look at the small business landscape, some retirement planning crises or crises. I don't know how to say that, plural. Business protection essentials. So what type of opportunities do we have? What type of executive bonus strategies are available and how that works? Some employee benefit solutions. We've talked about those throughout the year, but ultimately the most important part, and I can't stress this enough, is these meetings are always fun. These meetings are always, engaging. I love sharing resources and ways for people to grow their practice. But if you don't actually put this in practice, if you like what you hear, it's motivating and exciting, but then you have no idea what to do with it, that's where you got to phone a friend, call me up, see how we can implement and build a strategy for you. So it's not just information that you have, but information that you can implement. So when we want to look first and foremost at the landscape, the small business landscape is pretty intense. When you look at the United States, small businesses make up a majority of the actual businesses, with a total of over 90% of overall businesses is actually small business. I saw the stat online where it said it was actually 99.9%. But I wanted to at least just kind of give a margin of error. So, a total of over 90% of businesses in the United States are small businesses. And so when you think about that, that's over 33 million small businesses in the United States. I have a feeling that I'm going to be saying the word small business a lot, so I apologize in advance as I'm reading these and saying it. Um, but when you think about that, everybody on this call is a small business owner. If you don't believe me, if you have an LLC, if you have an S corp, sole proprietor, those are all private small businesses. So everyone on this call, anyone who watches this on the YouTube after, all somewhat or some form of a small business owner, which is important to understand. 47% of private workforce is employed by small businesses. 43.5% of the US GDP is generated by small businesses. And the average size, when you think about it, is really 10 or less employees. So you have an amazing field force that's designed with an army of 10 or less. And as I mentioned to you guys already, even for myself, there's only two people in Valor and it's not going to get any bigger. I say that now, but who knows? But nonetheless, again, you think from this landscape, there's just a lot of opportunity. I don't think a lot of people think about it that way. So when you think about some of the key challenges that these small business owners face, there was some surveys done, and the biggest concern that most of them had was really, cash flow management. Creating a regulated cash flow from their business. And, you could even look at our services in the insurance industry. A lot of ebbs and flows. So there's always that question of what type of cash flow management is there? A big one that I would say that we can easily help with finding and retaining talent. That is a huge concern, especially if they're top talent. I saw a video, on the TikTok earlier where someone was talking about top people in their respective organizations get burnt out because they're always relied upon. They're always adding, extra to help because of that mentality. And then ultimately, what happens is they end up leaving. And I'm going to be honest, that was half the reason why I left, Corbridge was that bureaucracy mentality, not really taking care of top talent and things like that. So that is a huge concern when you think about business owners, and that's always on their mind because of the operational costs, especially to try and find someone new if someone leaves. Healthcare costs, that's obviously a big concern. Even with the changes that are happening now, you're going to have a higher cost for healthcare if you're telling people to go on like ACA. But even to do private plans, there's obviously a cost to that. But there's a reason why this is so important for the business owner from an education standpoint. Regulatory compliance, obviously, that's something really that we don't have a huge footprint in because that is very niche to their business. But succession planning, only 30% actually have a succession plan. And I think as we go through this process, you're going to see that a lot of people, even though they have a succession plan, that might not actually be what they anticipate it to be. So just some of these major challenges that you see from small business owners, it's always important to know in the back of your head what your customer is going through because that can help you figure out the right solution for them. So we look at the retirement planning crisis, and you're going to see only 14% of small businesses actually offer a retirement plan. A lot of times, the small business owner thinks that their business is the retirement plan, so they really don't put a formal plan in place. It's kind of shoot from the hip, reinvest in your company, and hope that it continues to grow, and you use that as your kiddie pool. 53% of owners expect to work past the age of 65. I heard a funny joke the other day. It says, as long as you have an insurance license, you're never going to retire because there's someone who always needs some form of insurance. But nonetheless, a lot of these business owners don't really think of an exit strategy. And I know people who make a living off of just helping people build a exit strategy, not even including insurance or anything like that per se. Average retirement savings for owners currently is around 84,000. So when you think about that, when we look at the bullet points down below, when you think about the average retirement recommended amount is roughly 10 to 12% of your annual income. So if you have a high income earner making 300K a year, by retirement, they should have about $3 million. So where, again, when you ask the questions to the customer, where are you in this current goal? What is your trajectory? And when you start asking thought-provoking questions like that, it starts to build that rapport that you actually care about their well-being. So that's why I always say lead with questions, not with, pontificating on all the stuff that's happening. Obviously, what I'm showing you in the beginning here, you could kind of say is pontificating, but really the stats are important for you to understand that there is a definite crisis out there for business owners and why it's so important for us to talk to them. Statistics show you need about 10% of your take-home income going towards retirement. A lot of people are more focused in the now, even marketing, marketing platforms, commercials that you see on TV is focusing on what are they want your money, plain and simple. They want the focus on the now, get the memories today because we don't know what tomorrow brings and stuff like that. So a lot of people are overspending more than they're actually saving. But really, to have a fighting chance towards retirement, you need at least 10% of your take home going towards retirement. So same example here, the 300K person, they should be putting at least 30K away per year for retirement. Also, if anybody has any questions on stuff like this, feel free to put it in the chat. If it's appropriate for the slides that I'm on, I'll gladly answer it. Or if you want to put your little emoji hand up that you want to speak, you're more than welcome to. So never hurts to break up the monotoneness. So big question is always, why are these plans not offered, like retirement plans, things like that, that are really there to really help people, in the organization? And the biggest one, without a doubt, is always cost concerns. People are always concerned about what is the overall cost that they're going to incur to provide these benefits for their employees. There is an administrative burden. So if anyone has tried to, get someone signed up for a group plan, there is a lot that you ask of these people, these business owners, that they just don't want to do. You have too few employees. So we found in certain situations, if you're trying to do like a group plan for health or a group life plan, usually if it's under 10, it becomes a bit of a burden and rather expensive for what you get. So there's a toss up, and we have a few options outside of the norm for things like that. And really, it's almost 50% of the people polled in this have just a lack of knowledge about options. Once again, how many of us are so focused on our job as private small business owners that we don't have time to understand and educate what else is out there? So let's talk about benefits and opportunities. The opportunity for us at hand, when you think about small businesses without retirement plans, 1.2 trillion in potential assets, not billion, not million, trillion in potential assets. And when you have the ability to educate these owners, they're willing to contribute about 15 to 25% more when they understand some of the benefits that they'll get out of it. And we'll talk about some tax benefits they can get. So when you think about the true ROI on retirement planning long term, for every dollar invested, you have 3 to 7 in return, and the opportunity from a contribution standpoint and a growth standpoint for your customer. So let's start out with the most important part. We want to talk about business protection. We talk about buy-sell agreements, and with buy-sell agreements, there is a big problem because a lot of people think that they already have this set. So think in your head of some customers that you have who own a business. Are they alone? Probably not. As I already mentioned, I'm a 50-50 owner with my wife, but 70% of business owners have multiple owners, but only 20% have buy-sell agreements. You're probably wondering, some of you are like, what the hell is a buy-sell agreement? We'll talk about that in just a second. Because there are different types of buy-sell agreements. So you have a cross-purchase agreement with two owners. You have entity-owned if you have multiple owners. And then you also have a one-way, which isn't really talked about much, but there is a place for that too. So we'll talk about that in just a second. The idea in this scenario, as we talk about solutions that we can offer, life insurance and disability. A lot of people negate the idea of disability coverage, But folks, I'll tell you right now, one of the biggest misses we have in this industry is disability. And that is also, I guess you'd say, our own faults for not educating ourselves on why it's so important. So for about 2% of your take home, you can cover 60% of your take home tax free. So if you talk about taxable income, let's say it's about 80 to 85% of your take home, you could get tax free if you cannot perform the functions of your job. For the agent side, disability coverage, that would be roughly, most compensation for DI plans is about 50% upfront. So if the target premium, which is the annual premium, say it's 10K, you get paid 5K. And then they pay you anywhere from like 4 to 6% renewals every single year for the entire duration of the contract. So if you had a customer who is in their 40s and these contracts go to 65, that's a huge opportunity for you to create a recurring revenue of business in your practice while helping other people protect themselves. But we look at compensation strategies for, say, a life insurance policy with a disability plan, and depending on the type of entity that you're insuring or covering, that could be about a $20,000 case. The reason why we do buy-sell agreements is for business continuity. That's the most important reason. What we're trying to do is kick out unwanted ownership, reducing the idea that, it has to go out of the family and go to someone else due to improper planning. And it really just kind of puts a barrier. So when you think about it, the main structure of business protection is owner to owner. So this is how it works, and I'm gonna use stick figures because I can't draw to save my life. You have owner A and owner B, right? And they own a widget factory. So what happens when you talk about a traditional buy-sell agreement? I am owner A. Oops, let's go back. So I am owner A. This is owner B. Now, in this scenario, we both own a widget company and we're 50-50 owners. So I buy a life insurance policy on owner B, and then owner B buys a life insurance policy on me. I don't know why that's disappearing, but anyway. So I am the owner and the beneficiary of owner B's policy, and owner B is the owner and beneficiary of my policy. So why does that matter? Does anyone want to take a stab at it so I can take a coffee break here real quick? Or it's sleeping.
I
Uh,
can guess.
Go for it, Cynthia.
And the question was why is pretty much the owner of the other person policy. So is that right?
Yep. Why am I the owner and the beneficiary of owner B? And why is owner B the owner and beneficiary of my policy?
Well, if something happened in the business and if anybody else, well, by them being the owner, they can get the money. And they can't, the other person can't change them as a beneficiary. That's for protection. And that helps with the family coming back wanting to get money or trying to sue or anything like that. It just protects both of them. I don't know if that's right, but that's some of my guess.
Yep. You're on the right track. Teresa, I saw you went off mute.
Well, for a buy-sell agreement, the two owners buys life insurance policies on each other so that the insured person dies, they have that money to buy their share of the business out.
Correct.
And that way that remaining owner has control of the company. And usually that life insurance policy is purchased based upon their share, the value of their share of the business.
Yep. Yep. So that's you guys are both correct. So let's say, we each own 50-50, and well, let's say I croak, now I'm in a box. So 50-50 is still the phrase because 50% ownership goes to Mrs. Resch. That's the dress. Um, okay. So she owns 50% of the business because of the unlimited marital gift. So I pass on my assets to my wife, and so now she owns 50% of the business, and person B is doing 100% of the work. So what this policy does is person B owns the policy, so they're going to pay my wife out. And in exchange, the shares of the company are going to go to the other person, and now they're outright owners of the company, giving them 100%. So that's why we said in the prior screen, what we're doing is we're kicking out unwanted owners. Okay. Now, the same thing, let's say there are 3 owners, and I'm just going to make them heads, and we have a business. So the business is Widget Incorporated. And what happens is instead of, me buying a policy on that person and a policy on that person, we want to mitigate that because then you're looking at 6 policies. So instead, the entity buys a policy on each person, and the entity owns it, and the entity is the beneficiary. So instead of it being a third across the board, kick the bucket. Now it's half and half because that policy goes to pay off my wife with now curly hair. So the idea is that once again, you retain the ownership to the people who have agreed upon it through a contract as opposed to just verbal. And now all of a sudden you're ironclad and you have something in place. The worst thing that happens is you don't have it written, and then in return, everything that you work for becomes left up to suitability, left up to potential lawsuits, rights, and things like that. But if these owners had in paper a buy-sell agreement where it said what happens and when and how much it costs for evaluation, now it's written, now you can't legally contest it, and on top of that, it would allow this person, like my curly haired wife here, that she is forced to give her shares back in that extent because there's nothing she can do about it. They're paying her out as per the legal agreement. So when people are doing buy-sell agreements, you actually have to have a lawyer do the buy-sell agreement. Now, if you don't have a lawyer to do that, we have services where you can get paid for referrals like buy-sell agreements. Just so you know, if you want to hear more about that, just email me or text, carrier pigeon, whatever. So this is a entity purchase, and then last would be a one-way. So you have a owner who runs a company, and let's say it's a sole proprietor who owns the company, and he has employee 1 and employee 2. But employee 1 is really the go-getter and really the heir to this sole proprietor's business. Well, what happens is this person is in a legal agreement that they will take over when this person, the sole proprietor, either retires or passes. But to protect their investment from the wife getting the policy, there is a one way. It's not 2 ways, it's one way. This employee is actually going to buy a policy on the owner's life and be the beneficiary to pay off the spouse. So the biggest question that everyone always asks, is there a tax deduction? The answer is no. Okay. The reason is when you have a tax deduction, when people are asking for an S corp, God damn, an S corp, LLC, and sole are all treated the same. They're pass-through entities. So if someone is trying to get a tax deduction for a buy-sell agreement, it is after-tax dollars that fund it, and it is after-tax dollars that get awarded with the life insurance. If it is a C corp, there is a possibility that you can get a tax deduction, but you want to talk to a CPA. You are not legal counsel. Everyone get that? Thumbs up. Makes sense? All right. So moving on, I'm going to talk about another step in business protection when we think about key person. Key person,
Bill, I'm sorry. Quick question.
yeah, what's up?
Since in that same example that you used with the sole proprietor and the kick butt person that's doing the work,
Yep.
since there's no tax deduction, how is there an offset, or what's a good example of a benefit for them with the offset of paying it?
Well, the offset is so basically, I mean, the secret way you could say it is that like if I'm paying the premium, for example's sake, I have to give myself a bonus or I have to give myself money from the business. So the business will technically get some tiny little deduction, so to speak, because let's be honest, like, so Tiffany, if you and I were business owners together, as you can see, I'm large and in charge, so my premium is going to be a lot higher.
Yeah,
So as business owners, we bake in the additional cost after tax dollars to give to each other to pay for the premiums. The reason why you do it after tax, so if I had to give $1 million to your significant other to get your shares, you want to have that exact number. So you don't want to play around with fair market value, what was paid for the premiums to dictate the death benefit. You want a clean cut, clear distinction of what's going to be given to the significant other to buy out the shares.
understood. Thank you.
Yep, good question. So like when you think about what we just talked about, that is line item at the top. Okay. So now what we're going to do is instead of business owner to business owner, we're going to take it down a step on one side. So you have business owner, and then you have what's called here a key person. It used to be called key man, but thankfully we've moved on to gender neutral. So key person is when you have someone who basically is your right-hand person. You can't live without them. They're the ones who do all the heavy lifting. They're the ones you give to the keys to at night because they're going to close up shop, and they're your MVP, so to speak. So as you can see, some of the stats, 40% of businesses fail within the first 6 months of a key person passing away. Average revenue lost almost 20% in just the first year alone, and 35% of businesses have, key person coverage in general. So it's a huge door opener. Now, what I will say is the business owner, in my personal opinion, is not considered a key person. Why? Because they're the business owner. So business owner is looking at their generals, if you will, below them to protect the overarching business. Who do we have here that we need to protect that in case they don't make it home tonight, we still have money that goes up to the top level to protect the business. Once again, this is to protect the business. So typically what you look for is a 5 to 10 times valuation of that person's annual compensation. Or like I said before, DI is really 2% of that total cost of their annual salary to give you 60% tax free. So the idea there is if someone is disabled and can't work, instead of them owning the business but doing none of the work, they would get a supplemented DI plan to basically pay them to stay home and submit and give up their shares of the business. So in this scenario, again, there's valuations to figure out how to figure this stuff out. But once again, the idea is to ensure the continuity of the business. And if you need to sell it, it gives you an opportunity to sell it like in the black versus in the red at a discount because you lost that key person. You can add in money as part of the valuation, or you could hire a replacement, go out and use that tax-free money as a bonus opportunity for another person. So, how does it work? I saw this picture online. I thought it was hilarious. So I was like, well, if it is a key person, they're going to want to be treated like that, diva, if you will. So they get a tiara here. But like I said before, if you have owner up here, owner will have their own insurance needs, as we kind of talked about the business side. You actually get higher valuations on the life insurance side if you talk about personal versus business. So if you try to say, well, the owner needs a key person policy, well, the carrier will look at that as a 10 times valuation. They won't look at that as maybe a 25 times valuation for their income replacement. So that's why I say when you're talking about the owner and key person, I would keep those separate because once again, you have your as we call it, the key office personnel or your VIP, or EVP type people that are a layer below. So in this scenario, the owner, so we'll say owner buys a policy on key person, and the death benefit goes back to the owner to basically help revive his company or her company in case the passing of this person. So it is one-sided, just so you know. This is the owner protecting their interest. It is not about the key person getting some type of spiff out of it. Okay? This is once again no deductions. Remember when cursive was so cool? I don't remember that anymore, but deductions. I tried to do cursive like I was in second grade. Question popped up. Can you change the insured on these policies if someone leaves? No. The answer is no. You can't. But it's a kind of a segue to the next conversation. Because when you think about this, once again, it's the owner protecting their interest. It's not about the key person. It's only about the owner. Okay? They're protecting their business. Now, what if the key person says, dude, I'm your everything. You treat me like everybody else. You didn't do a retirement plan for the company, no 401ks. So why does it matter to me? That's where we talk about executive bonus plans. Okay. So the biggest challenge with small businesses is they struggle to keep executive retention. So 78% of small businesses struggle because of that. And the average cost for your key executives is around 240K, with a turnover rate of executives roughly about 23% annually. So you're constantly getting bombarded, recruited, pushed to a different location that your business owners need to protect their business. How do they do that? They offer these executive bonus plans. The benefit of that is you're using a life insurance bonus strategy focusing on income. The executive actually owns the policy, not the owner. And the reason why that's so important is because now your key person feels like they're wanted, desired, and the opportunity to protect your business has increased immensely, because you're now giving the people you want a bonus, and it's discriminatory, so I don't have to give it to everybody. So I can give this executive bonus to one person and not another person. Now, where some people kind of run this into a bit of a interesting dynamic, because I think they just want to sound cool, is as I mentioned, husband and wife own Valor. if I tried to give my wife an executive bonus, it doesn't make sense because as an S corp, we are on the same tax structure, so we're basically gonna pay it at the personal level. So there's no real major advantage for me to give my wife an executive bonus. But if my kid was no longer a dependent and he worked for the company, now we have a conversation to be had about how an executive bonus could work in several ways. But again, the idea here is the employee feels valued. You lock in an agreement. So say they have to stick with you for 5 to 10 years. And now we finally talk about how owners can get a tax deduction. So here's how it works. Okay. So once again, we have owner and we have employee. Okay. So owner gives a bonus, say 20K to the employee as a bonus. Now there's an agreement already written that this 20K is supposed to be funded to a life insurance policy with a focus on cash. Okay. And then what happens is that retirement, you can take out that income tax free, but if they pass away, you have the life insurance to give to the beneficiaries. So you have a self-completing policy, you have a retirement plan built in, but this 20K is now taxable to the employee. And what does that give the owner? A wage deduction. So now you have a story that you can give to the owner where they can help mitigate taxes and retain their key employees. The reason why the employee is the owner of the policy is that if I was the owner of the policy and I transfer that to the employee, well, now there's a fair market value on the cash, some taxation concerns, and then I don't really get the wage deduction because I would have been funding the money into it. The way you protect the asset is you have the executive bonus agreement plan set up. So there's hey, I, Phil Resch, am going to pay Cynthia $20,000 a year, but she has to stay with me for 10 years, and I will continue to pay this bonus on her behalf to be put into a life insurance policy, so on and so forth. And so it's all written out. Now, if there is a breach of contract, there's a couple things that the owner can do to protect their interest. You can do a split dollar plan where you can have each of them fund it, say a 50-50 between the employer and the employee, or you can have collateral assignment on there, which basically says that much like a bank holding collateral, if they leave, then I can recoup the bonuses that I gave them. So this one is often seen as a safeguard for the business owner in case the employee leaves early. Questions on that? Speak now. All right, moving forward. So those are the protection pieces, a little bit from the retirement side, but now we have the other side of the coin, the additional benefits. Okay. So we have, and this is where some people can run into an issue because they may not understand how all of these work. But we can help groups in the extent of offering things like group insurance, group health, gap protection, dental coverage, 401ks. We talked about pension plans last week. So again, if you haven't seen it, jump on the YouTube, Valor Financial YouTube, and it's up there. So we talked about pensions last week, 412(e)(3) plans, all opportunities out there that are available. Question came up, any age limit for this insurance? Nope, the age limits are basically dictated because these are like term insurance or permanent insurance. I forgot to mention, buy sells are typically term insurance, key person, toss up. Usually, some people will like to mold the idea of an executive bonus and a key person together. I would recommend keeping them separate. And then executive bonus is usually permanent insurance. So and from an age restriction standpoint, we have carriers that will go to 90. Yeah, Juan, what's up?
So this is maybe my greedy mind working. So just curious, would it be possible, let's say me and you are in business, I get a key policy, key person policy on you, you end up leaving, and then is it possible for me to hold on to that policy, and then when when you become of age, let's call it your 60s, and that policy is still around, could I life settlement out of that policy that way?
The reason why that wouldn't work is because, again, when you think about the opportunity of an executive bonus, if I was, first off, I would never go in business with you, Juan. I'm just saying, no. The idea, sorry, I couldn't help myself. The idea is that I want the tax deduction. So in order for me to do that, I have to give up control of ownership. Okay. But on the back end, I leave early. You can say, well, Phil, I gave you $20,000 for 8 years. So now I'm on the hook to pay you back that $180,000 or 160 that I essentially got as a bonus back to you because I decided to breach the contract. So you collaterally hold on to it if I don't fulfill my agreement. The only way out is death, or retirement, and that would be part of the agreement that we have from that standpoint.
Okay. What about in a scenario where it's just a term, super long, 35-year term, key person simple policy? Would I then be able to sell that
You can
policy when
convert
you're of old
it.
age to exit out of it?
Yeah, I mean, you're the owner of the term. So if you convert the term, so some people will, um, with key person, some people will buy permanent insurance. Why? Because now the asset growing inside of it, the cash value, is actually part of the business valuation. I still own it and I'm the business owner, so I still own it. Therefore, I own the cash value. You leave, I can still continue that policy, take out cash from it. You die, the death benefit goes back to me. So there is some validity to that from the key person, just not the executive bonus. But some people will do
Okay.
key person that way, because maybe I want to build another wing on Reshco, and I want to I want to be my own bank, if you will, kind of thing. So, so yeah,
Okay.
that's where you can do that.
All right. Thanks, sir.
Yep. So Richard asked the question, does the executive bonus need to be the same amount every year, or can it fluctuate? So the idea of the executive bonus is like the LERP strategy. So the life insurance retirement plan, same strategy with a business wrapper over it. Okay. So it's best to have a consistent premium payment every single year, because if it goes higher, then you might run into a mech issue. If it goes lower, then you have costs of insurance higher for that. So it's usually better when you have a consistent, and me as the employee would rather like to know what I'm getting from a bonus standpoint. So you have to remember that these are the cream of the crop, the top of the food chain. It's not the guy saying, "Do you want fries with that?" It's the guy managing the people who say, "Do you want fries with that?" kind of scenario. So they're probably used to a fixed salary and then getting a fixed bonus, as opposed to us as like, 100% commission, different animal. So that's why I would say from that standpoint, you usually want it to be the same, so it mitigates costs of insurance and things like that. But good question. So diving back into the employee benefits side, this is kind of the bow on top of it. This is a lot of what people in our industry, forget that we can do, even with just a FINRA license, or without a FINRA license, depending on where you are in the United States. You can offer 401ks without FINRA licenses. You can do SEP plans. You can do defined benefit plans. So those are benefits that you can do without a FINRA license. So if we look at, you know, the reasoning for, small business health insurance facts, 56% of small business owners offer health insurance. So you have a 50-50 shot there. And the annual premium, depending on, what it could be, as you can see, 7 to 22,000. There are tax advantages for the business owner to doing it, other than just retaining key employees. They're retaining employees. You have a higher percentage, as you can see here, satisfaction increases with benefits. So you have that benefit from the health side, higher likelihood that they're going to stay. Disability, 1 in 4 workers will become disabled during a career. Now, a lot of us in this room write living benefit term and permanent products. So I will use what I call the Doctor Strange example. So big Marvel fan. And I kind of laugh because of my sick sense of humor with looking at things from an insurance lens. So Doctor Strange in the movie, he's a very well-known surgeon. He operates with his hands. He was texting and driving, and he went over a cliff. They performed surgery. His hands were now shaky. He cannot perform his job anymore. That will not give you a living benefit claim. Okay, so those who tout ABRs as a benefit and you should cancel a disability policy, no, that's not the situation. Because a disability situation, you're going to find that if you become not able to perform your job functions anymore, you get 60% of your income tax free. And then maybe, as I say, Doctor Strange, instead of saving the world, he goes off and becomes a teacher. Who's to say which one is better? But you have the tax-free income that you're going to get to all the way up to 65 from the job you can no longer perform. And now you can go do something else and you're not limited. So that's the difference between some of that stuff. Go ahead, Cynthia.
So it is wise to, because I know people say, well, if you have living benefits, you can take advantage of that. But like you just saying, it's only certain, I guess, things you can apply for to get your money for the living benefits, like how this doctor here. So it's a wise to have both. And the question is, it's a wise to have a policy if they qualify for
Mhm.
living benefits and to get a DI policy. It's good to have
Yeah.
both.
Statistically speaking, you have a higher percentage chance of becoming disabled during your working years than you do dying. And so when it boils down to it, in the example that we've used from some of our other trainings, when we did DI specifically, you have the situation where, for example's sake, if I said to you, I could give you $100,000 annual salary, but if you become sick and can no longer perform the job functions, you get nothing. Or I could give you 98,600 and you will get 60% or $60,000 tax free if you can't perform the job functions anymore. Which one would you pick? And that's where a lot of people are like, oh, geez, well, option B is a no-brainer. And that's where you kind of hit them with the, well, it's only 2% of your take-home salary would protect you against 60% tax-free. Often the rebuttal is, well, I get something from work. And, oftentimes it's maybe 40% or it's a multiple of some sort, from that standpoint. So 40%. So we could provide gap coverage over the top of that to get them to 60% or maybe even 80%, depending on if it's a extremely different type of job, like a hygienist, not a hygienist, but a doctor who's making like $1 million a year kind of thing. So that when you talk about true disability, that is someone who can't perform the job functions. However, it wouldn't be always indicative of a heart attack, stroke, cancer, can't perform task 6 activities of daily living. That is where you have the living benefit story. This is, I can't perform my job functions. That can be, severe migraines, can no longer, go to the workplace. Doctors have to write this up. It's not like I could just walk in and be like, I have disability, and things like that. So you talk about back pain, can't performing the job functions anymore, things like that. That's what you talk about from the disability standpoint. So it is
Okay.
different animal. And so it's always good to, when you talk about disability, it's very easy to get a quote, name, date of birth, gender, job occupation, and job occupation along with annual salary, including bonuses, and if they have any disability coverage at their job. And then from there, we can figure out what the cost would be. And if what I always like to say is the gross worth the grief.
Okay.
So
All
So yeah, that's it is different. It's a different animal. So when you think
right. Okay.
in the top two and the one on the left with group life, that is something, we can do from the standpoint of offering as total benefit package to the employer, which can give them tax deductions, increase employee satisfaction, and then you get paid recurring revenue, you know, per member per month. You can take
Okay.
disability
What?
and separate it. Go ahead.
Uh-huh. I'm sorry. I was gonna ask, what company do you offer that offers the DI?
The best part about that is it depends on the person and their occupation. So we have you name it, we got it. So Emeritus, the Standard, Principal, Guardian, I believe we even have Mass Mutual, Mutual of Omaha. So we have all the carriers. We have a business partner called North Central DI who writes all the illustrations up for you. You just give the info, they handle everything. They can even do point of sale and they don't go on the application.
Hmm. Okay. North Central. Okay.
Yeah. So
Okay.
Todd Shield has done some trainings for us in the past. Great guy, great products. Like I said, just highly underutilized. So that's where we have a great story. All of these products here on this screen in the DI, if you're using it from a group standpoint, would involve a census. So when we look at, kind of next steps, what tools do you need and things from that standpoint? From what we look at from here, a lot of this involves a census, and we can get that to you as you're going to solicit these clients. Some people will say, like life insurance, will say, "Oh, well, just tell me what the cost is," and it's like, no, 401k plans are ERISA plans. They have to have actual factual data because if it's incorrect and the employer wanted to fudge some numbers and the IRS finds out, there's daily penalties, not like one-time penalty like a slap on the wrist. We're talking like daily penalties. It's a big deal. And so that's why we have people in place that help with this stuff from that standpoint for that last page. When you think about how do you find these clients, it's very easy. I tell people all the time, right across the street from me, about quarter of a mile down, is a grocery store. And in the grocery store, there's a nail salon, there's a veterinarian, there's a privately owned pizza place, a sushi restaurant, and a dry cleaner. So those are 5 to 6 opportunities right there to walk in and ask them, do you, Mr. and Mrs. Business Owner, I've lived here for 11 years. I've used your store before, for dry cleaning. I love it. Wanted to just ask you a quick question. I do a lot of financial planning, find ways to help business owners, successful business owners such as yourself, maximize tax deductions. And I just wanted to ask you, did you get enough tax deductions last year? And if I could show you a way where I could help you save more money from Uncle Sam, would you be interested? Who's going to say no? So, you think about something like that, then all of a sudden you have a 10 to 15-minute spiel as to the value proposition of what you have to offer. I have presentation decks, I can help you guys construct your own. Again, you don't want a Valor deck going in to talk about your organization, but if there's an opportunity where I can help you craft your message, because everyone's going to say something different. What I just said now is not what I said last time. I said the same thing. There's something about speaking off the cuff that helps me not sound too monotone, if you will. So that's where you want to figure out what works best for you. But when you talk about the process, as we've sat here today for an hour and gone through some strategies, sales ideas, and how to serve your customer, what I would say is that I hope that you wrote down at least 3 names to where the extent is that we can set up a call after. You can book my calendar. I do have a appointments.valorfs.com, and we can kind of grind out what you have, see if there's some opportunity, maybe some things that you didn't think about that I can help you with. But that's my job, is to help you maximize and find the right opportunity for the right client. So in this whole scenario and strategy, the idea is how can you help your community? Well, let's put together a 30, 60, 90-day plan to get you out there to execute and get in front of more people. But it all starts, I'm not chasing anybody. My job is to help you guys. And if you want to be helped, that's the most important part. So reach out. If you can't find time on my calendar, I will be traveling a little bit. Unfortunately, I have to go to Connecticut for a funeral next week. So Wednesday to Saturday morning, I'll be in Connecticut. And those of you in Texas, I will be in Texas the 23rd to the 28th. And I will have time if you're looking to do any client meetings, any agent recruiting meetings, and things like that. Just let me know how I can serve you. Okay. There's a question that came up. What happens if someone provides wrong health information or something? That's not on you. That's on them. So that's what I always like to say is that's a you problem, not a me problem. So if they're going to provide wrong information just to try and get quotes, then like I said, if they implement the plan, then it's up to them to justify that to Uncle Sam with their CPA. So we're at the top of the hour. We kind of hit overtime by 2 minutes. I still see, a good chunk of people in here. Anyone have any questions, you want to ask? You can unmute yourself, feedback, anything. While I'm giving you a chance to do that, I will share with you, we'll probably not have a training next week because I will be traveling Wednesday up to Connecticut. We'll be with family. The funeral is on Thursday. So respective of that, 99% sure that I won't have training next week, but we'll have it the following week for sure. So want to at least give you guys that heads up now. Any questions, comments? Good stuff.
Great stuff, Phil. Thank you as usual.
Always a pleasure. Well, appreciate it. Well, you guys have a great rest of your day. Thank you so much for the time. Oh, thank you, Teresa. Yeah, it was a 3-year battle with cancer. So, just rising one more question after listening to this PowerPoint. We'll go through the video one more time. Okay, sounds good, Preeti. You guys have a great rest of your day. Appreciate it, and let's talk soon. See you guys.
Thanks, Phil. Bye-bye.
Bye.